what I thought was typically, I mean, whether it doesn't matter what you're trading, right? Whether you're trading spreads or butterflies or calendars, diagonals, iron condors, whatever. Um, Sometimes some people trade by delta. So you may have a position that says, I'm going to enter with, I don't know, a spread, which is where the short strike is delta 30 delta for the put. Or you may trade a calendar at the money, or you may trade with a 50 delta, or you may trade a calendar with a 30 delta strike. So the point is, when you look at structures which are based on delta, obviously the delta kind of is dynamic, right? It changes depending on the volatility, depending on the underlying. And so if you're about to place a position, you look at the price and the platform is telling you, well, this spread or this calendar or whatever it is costs $3. The first question I ask myself is $3 okay? $3 is what the market is pricing right now, but is $3 a good price for this structure, or is it expensive, or is it cheap? It's like if you go to the shop every single day to buy, I don't know, a coffee, and a coffee costs about $2 every single day, and all of a sudden you go to the shop and it costs $1, you say, well, today there's a discount, there's a good offer. If on that day the price of a coffee is $5, you say, well, today's a little bit expensive, I'm gonna stay away. So that's kind of to give the context of what I'm trying to do. So how do we collect data to analyze and see, okay, how much would it be? So let's say that I want to trade a calendar. Okay, I'm just gonna make an example with a calendar, but again, it can be done with everything. And let's say that my strategy involves buying a calendar with 30 delta strike on the call side. It's a 30 days to expiration. And also I'm entering at, I don't know, 2:30 p.m. in the afternoon. That's the time where I usually enter my calendar. I'm just gonna make up this stuff. So the first thing I would do is I would use a backtesting software. Like you can use Option Omega, you can use Metasim, you can use I guess maybe Tested Trade. I don't know if if you can export the data. There's definitely other. I showed in the past an example with Quant Connect. Now, by the way, small commercial, which is for free. If you guys want to have a really good backtesting tool, I would say Metasim is probably one of the best that I've seen in the market. So it requires a little bit of understanding of how to use it, but it's by far, I think, one of the best software that I've seen. I mean, I'm not
Which
getting
one
paid.
is that again? Could you repeat the name of that,
It's
Rocco?
called Metasim. You may actually find it as deltaray.io, the website. So let me just show you deltaray.
Oh yeah, Delta Ray.
Again, I'm not getting paid. I'm just saying that this is, I think, one of the best backtesting there is out there. So you guys might want to check it out if you've never seen it before. Having said that, it's a little bit more on the complex side to set up something, but there's a lot of documentation, there's a lot of examples, so it's a fairly good one. But that's not the purpose of this today's presentation. I just felt it was fair to give a shout out to them. Having said that, for today, I'm actually going to use Option Omega, which is another one which and the reason I'm using this is because it's super simple to set up backtest. So it's gonna make this presentation quite fast. So let's just say that I'm gonna start a new backtest. And I'm gonna do maybe let's say from January 2022. I'm gonna pick the 1st of January until today's date. Actually, let's do until Friday, last Friday. Okay. And I'm gonna pick up. My strategy is, let's say, it's on SPX, and I'm doing a calendar. And my calendar has a 30 delta strike. It's a call calendar, so I'm selling a call 30 delta, buying a call at basically the same strike. And I'm going to buy this calendar with 30 days to expiration. And I'm going to, sorry, yeah, I'm gonna go, basically the short strike is gonna be 30 days to go, and the long is going to be, let's say, 45 days to go. Again, I'm just making up an example. This is not necessarily a specific strategy. Now I'm just going to disable the use exact TTE because I want to find something which is as close as possible to 30 days. Now, I'm also going to set up to only buy one contract of this strategy because I'm interested in finding out what is the price for this calendar for just a single contract. And let's say that I always enter my trade at 2:30 p.m. So I'm going to set up this time at 2:30 p.m. So that's my entry time. And one last thing, I'm not going to set up I'm not going to set up a profit target. I'm not going to set up stop loss. I really don't care about this backtest because I'm not using the backtesting software to backtest the strategy. I'm only using backtesting software to find out what the price at entry is. And I'll show you in a second. So I set up the strategy. Now I have to set up what the exit is, and I'm just going to exit based on time. So I know that I entered at 2:30 p.m. and I'm going to let the backtest exit 10 minutes later. So I'm going to set up let's say 40 p.m. So 10 minutes later, actually, is going to get out of the position. Okay. One last thing is I'm going to ignore trades with a wide bid-ask spread. And that's because I want to try to find trades where the prices are reasonable. And if there's a wide bid-ask spread, it might skew my numbers when I look at the statistics later on. So that's it. Just set up a simple backtest. I'm going to hit the run button. Now, this might take 45 seconds. So while this is running, I'm just going to go to Google spreadsheet, and we start with an empty spreadsheet. And what I'm going to do is I'm going to call this tab VIX, because I also want to understand how my price is affected by the VIX at the time of opening. So I need to download the data from the VIX. So one way to do this is using the function called Google Finance. And the first parameter is the ticker. So in this case, it's going to be the VIX. The second parameter is the, sorry, my keyboard stopped working. Okay, second parameter is the attribute that we want to analyze. Basically, whether you want to open, the high, the low, or the close. I'm interested in seeing what is the value of the VIX at the time of open for a particular day. Then the start date, I'm going to say, let's go from the 1st of Jan 2020. And then the end date would be today. So by hitting enter, I'm going to basically get this data where with the date and the value for the VIX for the whole time series. Now, I want to actually extract only the date portion. I'm not really interested in seeing what the time value, the time piece of this date is. So I'm going to add another column to the left. And this is actually the real date, the date part. And a simple way to extract the date from a timestamp is to use a function called int. Why does this work? Because a date, actually timestamp, is nothing else than a number with an integer part and a decimal part. The integer represents the date, and the decimal represents the time. So by taking the integer part, I'm basically getting the date portion of my timestamp. So I'm going to apply this formula for all of my rows. And then I'm going to format this as a date. So I'm going to go to formats, select dates. And as you can see, we just extracted the date portion of my data. One last thing I'm going to do, I'm going to call this, call it a name range. So I select the entire range of data. And here on the top left, I'm going to give it a name, and I'll call this VIX data. Okay, so we're ready with the data that we want to look at, but now we need to go back to our backtest. We ran the analysis, we have our backtest. We don't really care about the backtest. All I wanted to see was the trade log, where we can see the opening time that as you can see, it opened at 2:30 p.m. And here's the premium that was paid for this particular calendar on every single day. So what I'm going to do is download this as a CSV. And then I'm going to back to my Google spreadsheet and use the function file import. And I want to upload this CSV file that we just downloaded. So I'm going to say open. And I'm going to select to add this to a new sheet in my Google Sheet. And then I keep this check on because I want it to convert automatically text into dates, into actual values. But essentially, you can use the default, just click import data. And now we have all of the data from our backtest. So we essentially, what we're interested essentially is this value, the premium, how much was paid for that position to enter that, to buy that particular calendar at a given date. And at that particular time, because I know that I'm going to place my trade at that time, 2:30 p.m. every single day, or whatever I want to analyze it. So what I want to do now is, first of all, keep in mind that I need to add a couple of columns here. And the one thing we're going to do is I'm going to add another column and call this premium divided by spot. So essentially, I want to know what is the premium that I'm paid as a percentage of the spot price. Why do we do this? Because the price of a calendar will change. Actually, the price of any option will change, and it's proportional to the underlying stock price. So if the stock price is at 2,000, I will pay X. If the stock price is at 4,000, I will pay 2X for that same contract, with everything else being equal. So I want to come up with a measure which is actually independent of where the stock price is. That's why I'm dividing the premium by the opening price. So by doing this, so we do the formula equal to premium divided by the open price. Sorry. Premium divided by the opening price. And I'm going to propagate this to the entire column, and I show this as a percentage. Two more things we want to do here is I'm going to add another column, and this is going to be my VIX column. So I want to find out what was the VIX on that day, the VIX at the time of opening, on that day before I opened my calendar. So here I'm going to use a function called VLOOKUP. So this VLOOKUP function, I want to basically search for a particular date on my range, which was the VIX data range. So basically, I'm searching on that table and say, go and find that date on the VIX table, on this table here. Find the date, and for that particular date, give me back the third column. The third column is basically the value of the VIX, because this is a table with 3 columns. So I'm going to set value 3. And then the fourth parameter of this function is whether the data is actually sorted or not. And in our case, the data is already sorted because the VIX is, all the numbers are sorted from the oldest date to the newest date. And by doing this, now I pull down the VIX value for every single day. So this was the VIX at the time of opening. One last thing I want to do is I want to group all of these values of the VIX into different buckets. Let's say VIX from 10 to 15 or VIX from 15 to 20. So a simple way to do this is to, I'm going to add another column here. I'm going to call it VIX bucket. And we can use a simple formula, which is the round function. Sorry. And we're basically, if I want to create buckets of size 5, all I'm going to do is I'm going to divide the value of the VIX by 5, because I want to have increment of 5, around this number, and then whatever the result, the integer part is, I multiply it back by 5. And all of a sudden, I've created buckets from 20 to 25 to 30 to 35, so all in increments of 5. Okay, so I'm only interested in these 4 columns, so I'm going to highlight them in blue. And now we can start doing some analysis. So first thing we might want to do is look at the distribution of my my prices as a percentage of the actual open price. So I select this column and click on insert insert image for the chart. And I'm going to change this chart to be an histogram chart. So this is giving me an idea of what is the distribution of the prices of this particular strategy at 2:30 p.m. every single day, and telling me that there are cases where the price is almost 100% the value of the underlying. If you see like 100%, basically means that if the S&P is at 4,100, then the price of my calendar will be $4,100. If it's 0.50, means that it's about 50% the price of the underlying. So long story short is this gives you a bit of an idea of where is the average, and we want to buy something at a price which is either on the average or below the average to give us a good price. If we see that today the price of the calendar is very expensive, well, it might not be a good day to buy this thing. So first thing we can do is, again, look at this distribution of prices. A second thing we can do is analyze, for example, is there a correlation between the price of my strategy and the value of the VIX? So what I can do is I can select, so I'm going to select these three columns. I'm going to select insert of another chart. And I'm going to change this chart. So first of all, I'm going to remove all of the series. And what I want to do is a scatter plot, where on the x-axis, we are going to look at what is the VIX. And on the series, we're going to look at this value of the premium or versus the spot. And well, in this case, it doesn't look like there's any real correlation because all these dots are kind of scattered all around. There are cases where you would see maybe the dots to be kind of, you would expect that maybe if the volatility is higher, the price of this calendar could be higher, but this doesn't necessarily seem to be the case at this particular time with this particular data. So again, this is just another chart to give you an idea of, is there any correlation between the VIX and the price of this calendar? And then a final thing we can do is go back to our data, select all the 4 columns, and insert a pivot table. And I'm going to insert this into a new sheet. And we're going to, this time, use the bucket on the rows. So we're basically grouping by all of the values by the value of by the range in which the VIX opened. And then on the values, I'm going to, for example, look at the premium, the values. Why is it not adding it? There you go. And we're going to look at what is the average value of the premium. So this is how much did we pay on average on this calendar when the VIX was at around 15 or 20 or 25 and so on. We may also want to add the standard deviation as another measure. So I'm going to change this from sum to standard deviation. And let me just format this maybe a little bit to be numbers. And then, but we actually are more interested in the ratio rather than the actual premium, because as I said, the value of the premium might change a lot if the underlying has moved a lot from my entire history. So what I'm going to do is add the premium. And here again, I want to look at the average, and then the ratio of premium versus spot, also the standard deviation. And in this case, we're also going to show this as a percentage. So what this is showing me is what would be a typical price for a calendar, well, an average price of a calendar with that delta at a particular point in time when the VIX is around 30 or somewhere around that number. Right? So as you can see, obviously, as the VIX gets higher, the price tends to be a bit higher. So here's, for example, 2,300 versus 2,000, or in percentage-wise is 54% versus 43%. And this is the standard deviation. It gives you a bit of an idea of how much the price fluctuates around that average. So again, just simple stats, but it can help you understand whether the price that you're paying today, is it an average price or is it an expensive price compared to what I've seen in the past? So simple math you can do, I mean, simple analysis you can do. And we're using a backtesting tool, not for the purpose of backtesting, but just for the purpose of extracting the data so we can then analyze it. Any questions?
Okay, so if it is high, seems to be high in terms of historical range, Is there a possibility that it might be a breakout and then this might be actually still a good time to buy?
Well, the way I look at it, let's say that today the VIX is at 20, and so the average price would be around $2,000 for a calendar. And I go into my platform and see that the price for my calendar is 2,000 and a half. Well, it doesn't look like a good price. It's definitely quite on above the average price. So today might not be a good time to buy that calendar. Uh, I might consider selling the calendar maybe.
So
Uh,
basically, this is sort of a volatility adjusted history, a comparison of the price of the
yeah.
spread to what it normally has been in the past.
Correct. So you can make a decision whether is this a good day to buy it, or is it too expensive today compared to the past, or is it cheaper than the past? In that case, it might be an advantage. Obviously, future is not necessarily a predictor of sorry, the past is not necessarily a predictor of the future. So just because you've seen in the past a price of average of $2,500, it doesn't mean that that's going to be the price you're going to pay in the future. Market might have changed, things have changed, but a simple analysis like this at least can give you an idea for that particular position, with that particular delta, with that particular time of the day, what was the price in the past for this strategy.
Yeah, and I've seen people who built these elaborate spreadsheets, and you really have to do it in a way to see how your spread was priced in the past to get some idea. And so this is a way of improving those spreadsheets by making the values in them volatility adjusted, as I interpret it. Does Dan, do you follow that? Or does does who else? Well, I guess Scott has a question here. I don't know if it really matters, but he says, do you see it there, Rocco, on the chat?
Scott's, so it says the VIX Open really isn't really VIX Open the closing price of the VIX on that day. No, because if you actually, as far as I know, when I go here in my in the Google function, you can actually ask for the close price. So you have open, high, low, and close, and that will give you a different price for the closing at that particular day. So in theory, as far as I understand, the open attribute should give you the value of the VIX at the opening of that session.
Okay. Is there anyone here who has who trades a spread and looks at the value of the spread and has charted it from, in the past to see whether it's a good value or not? I guess another.
Yeah, this is
Okay,
Ron. I can jump in there a little bit.
go ahead.
So I've done this kind of stuff before, similar through to Rocco, and it's fine to do this kind of analysis. I just would caution, and I'm sure Rocco is fully on board with what I'm about to say, I think anyway, but it's like a guideline which can be very rough. So it can give you an idea, but sometimes, especially with the structure that Rocco is looking at here, it can get tricky. And what I mean by that is that the structure that he's looking at is a calendar, okay? And that's two options, not one. And what's more than that is that the two options are on different DTEs. And for people that have gotten heavy in through to calendar trading or diagonal trading in the past, I'm guessing that you should know that your term structure is a hugely important factor in both trying to analyze edge in terms of entry and exit, right? So in other words, what I mean by term structure is the differences in IV between the two DTEs of between your short and your long. So you could have an example, see, because it's fine to look at VIX, and this is what I'm saying. It's fine to do this, and I know Rocco knows the math much better than I do, but I think he's kind of purposely keeping things simple, which is good as a start. But when you're looking at things like the VIX as a measure of so-called volatility, that is looking at 30 DTE at fixed maturity. Okay, and I know that he therefore on purpose chose the short of the calendar to be at 30 DTE in order to make that match, which is cool. But then he chose like 45, I think, DTE for the long at the back, and you have no idea what the IV of that long is, and therefore you have no idea what the term structure is between those two. The term structure could be very favorable, or it could be very unfavorable, but you have no idea because you're looking at the VIX, right? So term structure is, but of course, doing that level of analysis is far more complicated, which is, I think, why Rocco didn't show that. So this is like, again, it's fine to look at this kind of stuff, but in order to get, I've just seen people kind of put all their eggs into this one basket and say, look, since this spreadsheet here is telling me that this calendar is overpriced, I'm going to sell it, or vice versa. But you're completely blind to term structure, which is a hugely important factor when it comes to trying to find edge in a calendar, right?
So is it true that really a VIX we're using it as a surrogate for the volatility of each of the two legs, and that really it would be better to use implied volatility of each of the two legs?
Well, VIX is a measure of the implied volatility of the entire chain, but as Ron said, it measures a 30-day fixed expiration, or, well, it's an average, it's a time-weighted average, but basically, for all intents and purposes, is a 30 days implied volatility of the entire chain. So, but as Ron was saying, I mean, you don't know what happens with the other leg, the one you buy behind. So, that's perfect, Ron. You actually, it's like a magician, and you're just exposing all the tricks. So, very well done. I would just say, definitely, this is more helpful if you're looking at either a same expiration, like study like spreads or butterflies or BWB or whatever, or if you're looking at a far dated calendars, for example, where the difference between the two legs tends to be a little bit more stable, while the term structure tends to be wildly changing when you're looking at shorter term expirations. When you go to 150 days, 200 days away, the term structure tends to be a little bit more stable. Obviously, it can change, and there requires a lot of more analysis. But again, spot on, Ron. Guys, be careful. I mean, this is just a course analysis. It's not like it's not going to be your crystal ball for determining whether the price is right.
I mean, the more sophisticated the model you have, the better you could price it, I guess. I mean, there's a whole bunch of other questions, and this is just a good start. A simple model is better than which most people have, which is nothing. But you could go on and improve the model. Certainly.
The other thing that if you wanted to get as accurate as possible, but there's like a bad side effect to this, but if you wanted to get it, as close as possible as you can, you ideally want the exact DTE to be matching what your current DTEs are for whatever option trade you're trying to do. But then that massively is going to cut down on the data sample points that you actually have from the backtest that you can choose from. So therefore, that becomes much more difficult too.
Yeah, the reason is a good point, because the reason why I didn't choose when we go back to the test, right? Okay, I messed up. So here I purposefully removed the option, where was it? Use exact DTE, because when you choose a 30 days and then 45, it's very difficult to find exactly those two expirations. If this was a simple strategy like a spread, it might have been much easier. I don't know, do they have like a spread here? Long put spread. So if I do this, where everything's at 45 DTs, then actually make more sense to always try to match exactly the same date. And you might be more likely to actually find those expiration. But as Ron points out, if the more you're precise, the harder it is to find entries. So you end up having a spreadsheet with only few entries, or fewer entries that you would get if you are a little bit more flexible and kind of toggle this off. But it's a trade-off as to how accurate you want to be versus how many trades are you going to get in your CSV file. So again, we're trading off one thing for another.
Another question would be that I have is, if you find a discrepancy, you say, gee, it's overpriced, I'm certainly not going to buy it, or it's underpriced, I'm certainly not going to sell it. And if you see that, what is the most likely cause? Is it simply an imbalance of supply and demand in the market momentarily, or what would be another explanation of why it would be priced incorrectly?
I think, well, if you look at calendars, the answer is completely different than if you look at something else, because calendars are kind of beasts. I mean, as Ron is pointing out, term structure, is there a contango or backwardation situation going on, and they could completely change the price of your calendar. If you're looking at structures which are on a single expiration, it could also be an effect of of overall volatility, or it could be the skew itself. Because with even if you're looking at a spread or a spread where there's a high distance between the two strikes, the implied volatility curve is not going to be flat. It's going to be skewed. So depending on how much skew there is, it can also change the value of your spread. And that's why I also, like in the past, I talked about how do we try to measure the skew, and how can we potentially understand whether is the skew in our favor or against us. So that gets into, I mean, the more you start digging on this thing, the more nuances you find. Again, was meant to be just a kind of a quick introduction for someone who's never done any analysis like this. At least you have something to start with.
Yeah, I love it. And Scott is just adding there that he likes to sell higher volatility, where the leg that he's selling is higher IV than the leg he's buying.
Yeah, you want to find a backwardation, basically.
The other thing to keep in mind as well is bringing it back down through to like a core principle. I think sometimes people get lost in the math a little bit. And if you think about what IV is, it's kind of like a prediction of the future. Okay, it's a market basically pricing options in the future. So therefore, they're literally looking into their crystal ball, trying to predict what the prices will be, and nobody actually knows what that is, right? Does anybody? Do you think that something weird is coming up on November 5th, right? Which is a week out. That has massive pricing implications on the options, right? In terms of the volatility. Well, it's the pricing which is then reflected in volatility, but it is the market essentially trying to predict the future. It's got nothing to do with so-called efficient market pricing of what is the math in the option chain right now. It's the market trying to price the crystal ball, right? So you kind of have to keep that in
there's a
perspective
very
as well.
fundamental aspect to it that's not purely technical.
Yeah.
Well, thank you very much. That's excellent discussion, and as Ron has mentioned, it's and as Rocco himself said, it's just a start to giving you one idea to improving how you estimate the prices that you should be accepting. Any other general comments on anything we've covered, or any other questions on general points?
Yeah, I
guess
jump in quickly there. Just to
Yeah.
answer one of the questions that came up before about technical analysis, right? So the tasty one here doesn't really have anything yet. Option Omega, you'll find that they have very basic TA indicators there, like moving averages and RSI, that kind of stuff. But one of the key features about Metasim, I mean, it's got a ton of stuff that is advanced, in terms of, well, just off the top of my head, things like, tracking certain conditions at trade entry is extremely useful. So for example, if you want to track the actual initial credit that you receive for a particular trade, or the total amount of vega that a thing might have, whatever it is that you want to track, you can set all these variables to be tracked. You can do adjustments. So it's not just like this where, it's a slap on, slap off trade. You basically say, this is my structure, but then if this happens, then adjust like this, add a vertical here or something like that, or add an option or sell an option or something like that. So it supports adjustments, it supports scaling, it supports a whole bunch of stuff. But one of the key things relevant through to the TA stuff, which I think is awesome, is that they allow you to have a completely custom signal file that you can bring in through to the backtest. So what I mean by that is that let's pretend that you use the fanciest indicators on TradingView, and you don't just use one, use 5. Okay, this custom thing that somebody created that doesn't exist on any other platform other than TradingView, let's just say, and use 5 of these really complicated indicators for your trading that you love. Well, perfectly fine. Go to TradingView, export your actual data, which is everything that you see on your chart. So like you zoom out, you then export that through to a CSV file. And now you've got all of those indicator signals for every single day going back for years. And you can literally then grab that CSV and put it into Metasim. And now Metasim can now see each one of those columns, and you can refer to the columns by the column header. So let's say that, it's called indicator 1, 2, 3, 4, 5. You could literally now code your trading system in Metasim for option trading to basically say, if indicator 3 goes above a level of 30 and indicator 5 is below a level of 2, or whatever weird thing you've got, you could basically reference that custom signal file and then incorporate that into your option trading. So that gives you just complete power to do almost anything to do with TA.
We'll have to get another demo of Metasim. They did present, a couple of years ago, so we'll have to get them to do. Do you think, Ron, they're like, one doesn't really hear about Metasim, I think, in most of the YouTube traders and such. Do you think it's like gaining any market share relative to ONE or something like that?
It really comes down to your trading style. Most retail traders, let's just say, don't really believe in backtesting, and they like to adjust things as they go, and therefore they don't actually have a mechanical trading plan. They basically say, this is what I do, but if things happen, then I adjust on the fly. That's fine if that works for you. But this kind of relates back through to your initial quote from one of your slides there, that the majority of retail traders lose money. I think that's part of the reason why. When emotions get involved, you run into problems. Our emotions are our biggest enemies when we trade. And if you don't have a set of defined rules, ideally those rules are fixed and have been thoroughly backtested with good backtesting software. Then in at least in my personal opinion, that's the best way to go. And then you really just try and stick to your trade plan that has been well defined and well backtested. But you need technology that can help you do that. And Metasim is an excellent tool to be able to do that, because you can backtest far more complicated trade plans. It's not just a slap on, slap off thing, kind of like what we're seeing here with this type of technology. You can do far more advanced things, different types of profit targets, different types of stop losses, technical analysis integration, scaling, a whole pile of stuff, and then deeply analyze those results, and then potentially go in and say, oh, okay, this isn't working, so let's tweak it. You might say, well, that's curve fitting. Yeah, pretty much anything is curve fitting, but that doesn't mean it's not profitable. Okay, you can have something that is circled curve fit, but what you can do easily to see if it's the circled negative aspect of curve fitting is to then put it into incubation. So you're essentially just trading it with paper money. And then you look at the equity curve. And if after a series of months of being in incubation, you see that the performance is roughly in line with the performance that you saw through your backtest, that's telling you that it's probably good. Like the chances of it circle being negatively curve fit, that it's not going to work in the real world, are greatly reduced by you having confirmed that during incubation over, say, a 6-month period.
Oh, absolutely.
It performed, perfectly adequately. But the key is to have a trade plan that is, I think option trading that probably most of the people in your community do is going to require a trade plan that is more complicated than a simple slap on, slap off type of thing. So if that's the case, you need therefore something such as Metasim that allows you to, again, integrate technical analysis that you might be using and all that kind of stuff, and now actually define a 100% mechanical trade plan that you can now backtest over a 10-year period and ensure that it's working well. So for my community in Trading Dominion, we do this extensively. For us, it's a must to have thorough backtesting of your trade plan. But Metasim is definitely one of the big ones in terms of the advanced ones. Now, you mentioned OptionNet Explorer. OptionNet Explorer is great for manual backtesting, not automated backtesting.
That's true. That's
right?
true.
So,
and you would say Metasim is adequate for.
Yes, Metasim is an automated backtesting technology. There's also another one that was created by another guy from our community called Charm Traders, and the product is called OptiTrade, and he kind of has a mix of. Think of it. I'll use the word clone, but think of it as like a similar product through to OptionNet Explorer in the sense that it is a manual backtesting and also for manual trading type of technology, but it also can do automated backtesting as well. So it's kind of like a combo of both. So those are really.
What do you think of people like John Locke, who have supposedly fully specified rule-based systems? Do you think those are okay?
How can I say this? All right, if you were to monitor how, and John puts out tons of stuff on his YouTube channels, okay? And he does have, let's just say, defined trade plans in terms of, you should do this in this situation, this and that other situation. But what you'll find is that he still injects plenty of discretion in his trading. One aspect of that is that he has been doing his own form of technical analysis for a long time. And that technical analysis is not 100% mechanical. He'll do things like see patterns, like he'll say, oh, there's a head and shoulders here, and there's a this over there, and blah, blah. And those things are not mechanical. Those are things that he just eyeballs the chart and gets a feel for what he thinks the market bias is. And based on that, he then translate that market bias to his option trading. Therefore, he's actually injecting discretionary decisions into his trade plan. So
Well, he
since
has
that's
all
the
these
case,
levels, right? He has like M3 is a set of rules, but then he has levels which definitely do include technical analysis. But I think he claims that even the basic levels are
yeah, all I'm
profitable.
saying is that there are different degrees of so-called mechanical trading, right? You've got 100% mechanical trading where you literally plug it into your backtester, such as Metasim, and then once you're happy with that, you literally trade it exactly the same way. And then you've got like a hybrid where most of your rules have been well defined, but there's still a degree of discretion that is involved in the actual trading of that strategy. So it's up to each trader to find, which path they prefer. My community is more now on the side of being ideally 100% mechanical.
Great. That's great to hear. Dan, did you want to explain anything more you've been showing here? Or?
I was just curious about what's the expense of some of the, I guess they've got various options of depending on what you elect to activate for the option Omega or the.
What's the cost?
The other
Just saying, what's the cost of Metasim or option only? Is it expensive, Ron?
It's actually, I think Rick there just posted a link to the plans. Yeah, so
Metasim.
there you go. So if you use that link there, that takes you to the pricing.
Okay. All right. Let me go back to the chat. Thank you.
Oh, it says like standard is 42 a month, advanced is 50 a month. Well, that's not too bad. That's not too bad.
You can see they've got a free plan too, so you can use that just to kind of get over that. There is a bit of a learning curve for sure, in learning how to use this because it's much more powerful than other technologies that are out there. So of course that implies, a higher degree of technicality, if you like, in terms of doing it. But there's no actual coding. There's no programming involved. But you do need to spend a few hours, kind of thing, learning how to do more advanced options backtest with this technology.
Well, I think those prices are much cheaper than ONE.
Yeah, but remember that they're different things, okay? ONE is for manual backtesting, not automated backtesting. Metasim is automated backtesting.
Very good point.
Also, keep in
So
mind that you wouldn't use, well, I guess you could these days with because Metasim also is going to enable like live trading on these strategies.
Yeah.
But the point is with ONE, you're actually looking at your strategy on a day-to-day basis. If you have Thinkorswim account or Interactive Brokers account, you can connect it to ONE and manage your positions through that. So you can analyze your position on a day-to-day basis, keep track of the changes. So what I'm saying is that it becomes, to me, is like if you have an Interactive Broker account, you actually must have ONE to manage your trading.
Yeah.
Because you can't possibly just do this using the platform unless you're doing some simple trading. Again, depending on what type of strategy you do. If it's a spread, that's fine. But if you do complex strategies, there's no way you can keep track of them on just the platform. You need a software like ONE.
Yeah.
okay, you just said you needed some type of tool. You can't even Interactive Brokers. You're saying does not have enough
No.
Yeah, I fully
capability.
agree with that. That goes back to your original slide comparing the three brokers to, saying is, Schwab now the best option trading platform. And if you're the type of trader that has gone deep into being able to look at a risk graph and essentially trade from that risk graph and understand a whole pile of stuff by properly knowing how to analyze a risk graph, which is, again, the kind of stuff that, you know, I fall into personally, then you really do need something like Option Net Explorer. But in terms of ranking them, so yes, TOS is the best out of those three in terms of IB and Tasty Trade. Tasty Trade is good for, you know, essentially beginning option traders that have very, very basic slap on, slap off style strategies. That's you know, fine. But even their risk graphs that they have on their platform are, you know, very basic. IB is horrendous. All right. The risk graph that they have is just so bad it's not even usable. So IB was definitely like level 0. Tasty would then be above that. But again, it's very, very basic. TOS is much better, but still, in my opinion, not as good as having something like Option Net Explorer. So regardless of which broker you choose, in my personal opinion, you know, we still recommend that people still purchase Option Net Explorer as not just for manual backtesting, but also to mirror your live trades onto and to manage your live trades. So that's one bucket, but then a separate bucket, which we consider extremely necessary, is to then also have a good advanced options backtester, such as Metasim or Charm Traders OptiTrade.
Or which was the second one you mentioned, Ron?
The company is called Charm Traders.
Oh, Charm Traders.
The product is called OptiTrade. So, and again, it's kind of like a combo between Option Net Explorer and Metasim, if you want to think about it that way. But
Oh,
just,
really?
I think,
So,
yeah.
Really? So you can use it for both purposes?
Yes. Yes.
Well, we should
The
have
reason I chuckle a little bit is because the, you know, Metasim feel that they kind of got a bit ripped off by Charm Traders kind of, you know, cloning them. So, but you know, that I won't get into that. But yes, it is another viable technology that's out there that people can subscribe to. And it does have a learning curve, just like Metasim does, but very much well worth getting into if you want to get into a more advanced options backtester, automated backtester.
Well, it's definitely worth. We'll have to have them demo too, if they want to. Brandon has shared a link to Charm Traders, which is good, and Rick, it's in our log, and Rick has pointed out Option Omega pricing, which is $99 a month, so it's like twice as much as Metasim. I'm very rough, very, very roughly. Well, thank you very much to everybody. I think we better, unless anyone has any, thank you, Ron, for all those added comments too. And thank you, of course, especially to Dan and Rocco for both our panel and our presentation. And I think we need to let it go there. Thank you very much for joining us.
Thanks, everyone.
Thank you. Thanks so much.